clients say, well, Dom, I don't need to be that conservative. She's saying, I'm willing to take a little bit more risk. So I say, okay, well, what we can do is, how about if the market's down 25, what I could do is, what if I do something called a downside buffer? So what if I gave you 20%, 100% protection, where if the market was down 20%, you would be down 0. But if the market was down more than 20%, you would start losing $1. But if the market was up, I could get 16% a year, 100% of the market. And I could reset that every year. So if the market's down 25, I would be down 5. The market's up 25, I'd be up 16. Well, that's better than 50% of the upside. And that's still good. You know, it's interesting, a number of my clients, interest rates weren't really very high in January or December of 21. But the clients that bought these at the beginning of the year, they didn't make money last year, they didn't lose money, and then they got to rebuy the market at the current value. So think about that. Market's down 20%, I don't lose anything because 20% was my buffer, which the market was down 20%. And then I rebuy the market at the current value. So anyway, the one that I like, the one that a lot of you people in the room are in with absolute return, is what if we built one that said, I don't want it capped. I want 70% of the upside, but still give me a 20% buffer. Well, market's down 25, I'm down 5, but market's up 25, I'm up 17.5. I like this one. I like this one because markets tend to bounce hard after a down year. So let's look at the return of these two. I'm showing, ladies and gentlemen, the 16 cap, and I'm showing the 70% no cap. You can see that the 16 cap does a little bit better, 8.43. But look at this. Oh my God. You can see how that buffer protects you in a down market. Here's the point I'm trying to make, and this is really important. This is math. This is arithmetic. This is not me and Pat and his team deciding when to buy or sell. We're not predicting markets. We're setting it, we're letting the math, we're letting treasuries do their thing. And look at, now this blows me away. Are you telling me that with this strategy I could do 100%, I could do more than 100% of the market? Marlon, I'm a fiduciary advisor, which means that if I put you in bad stuff, you could sue me, and I would have to write you a check. It's an interesting story. I remember at the end of Obama, the beginning of Trump, there was a law that the Securities and Exchange Commission tried to pass. What it said was it wanted to make every financial salesman a fiduciary, which means that every time you sell an annuity or a piece of junk, if it's inappropriate, they would get sued and they would lose. And so on my 3rd floor of the building, comes up to my office and he kind of comes in, he goes, what are you going to do? I go, about what? They're trying to pass this law about we all have to be fiduciaries. I'm like, dude, I've been a fiduciary for 30 years. Edward Jones, you don't have to be a fiduciary. You could sell shit, excuse my vernacular. Rick, did you want to say something?
Oh, no. I'm completely annoyed by that whole situation.
Yeah. Oh, thank you. Okay, thank you. Thank you, Veronica.
You're good at being your fiduciary.
Okay, right. So the bottom line is, are you telling me that Marlon, if I put 100% of your money at your age in the S&P, I could get sued? Because, you know, I remember the crash of 09, the market was down 72. I mean, it was down 40 in 08. You can't experience those losses at your age, at retirement. So, but here's a strategy that says, I'll outperform the market. I'll do better than being long the market, but I'll be guaranteed hedged. It's a beautiful thing. And you're 100% backed by a U.S. Treasury if you hold it for a year. So it really is exciting. On a 2-year note, talking to Pat, I said, you know, Pat, what if the client wanted 100% of the upside? Yeah, you buy a 2-year note, I'll give you a 15% buffer and 100% of the upside. Why would you ever buy the market if I can get 100% of the upside? That's better than just being long the S&P and down 25 when I'm down 5. It's a kind of a no-brainer. It's definitely kind of a no-brainer.